Okay, so now we're going to turn our attention to investments where we have influence but not outright control. So remember, here we're talking about influence over the investing, the financing and the business operations. Now remember, essentially, if we have influence over another entity, we're going to use something called equity accounting, meaning the investment in the parent company's balance sheet is going to be equity accounted. Now, what does this equity method mean? Often we hear it referred to as a one-line consolidation, because we're going to see one line in the parent company's balance sheet and one line in the parent company's income statement. Okay, so let's have a look at our equity method. Remember, we're using this for associates where we have influence, but also typically it's used for joint ventures under IFRS and US GAAP. Okay, so 20 to 50% ownership, remember those are the bright line criteria, a guideline, not a rule. Okay, so in our balance sheet, notice it says reported at cost. So initially when we buy the security, we're going to report at cost. Okay, well, now what is cost? Well, cost of course is purchase price, but that purchase price essentially really represents a couple of elements. So that cost is equal to our share of FMV net assets plus goodwill. Okay, let's break that down. What is our share of FMV net assets? What we're going to do is take the associate and we're going to look at its balance sheet net assets. But we're not going to just necessarily use balance sheet values. Any asset or liability in that associate's accounts needs to be adjusted up to its fair market value before we look at net assets. Okay, so we make fair market value adjustments to its balance sheet at the date of acquisition, then we look at its net assets, and then we bring in our share of that. In other words, if you own 30% of the equity in the associate, you bring in 30% of its net assets. The other element we're bringing in is goodwill. Okay, now, a lot of people will tell you that equity accounted investments, you don't have goodwill. The reality is we do have goodwill, but it's hidden away in this one-line consolidation. In other words, it doesn't appear as a separate intangible asset. Now notice it then says reported at cost plus earnings minus dividends. Now initially at the date of purchase, it's reported at cost. But at the end of the first year, we're going to bring in our share of its net income. Okay, so percentage share of its net income minus our share of any dividend that it pays. Now, of course, net income minus dividends is retained earnings. So what we're doing essentially is we're changing our balance sheet investment for our share of the change in its retained earnings. Now, saying our share of the change in its retained earnings is pretty much the same as saying our share of the change in its net assets. So we're going to increase our balance sheet investment each period by our share of the increase in its net assets. So let's have a look at that. It says the balance sheet investment, our share of the company times its earnings minus our share of the company times its dividends. That's just what we said up here. Now, okay, so the balance sheet investment is changing each period by our share of the earnings minus our share of the dividends, which is the same as saying our share of its earnings minus its dividends, which is the same as saying our share of the change in its retained earnings. And remember, our share of the change in retained earnings is essentially approximately equal to the change in its net assets. Okay, so therefore, at the year end, our investment in the balance sheet, our one-line consolidation, our investment essentially is going to be made up of three component elements. It's going to be made up of our share of the fair market value net assets at acquisition, plus our share of any change in net assets, plus the goodwill. Really what we want you to take away from here is that the balance sheet investment is changing by our share of the change in retained earnings of the associate. Okay, so if you own 30%, you take 30% of the change in its retained earnings. But be aware, what this is doing is meaning that our balance sheet investment is always reflecting our share of the net assets in the associate. Notice what goes on in our income statement. Remember, we said one line consolidation, one line in the balance sheet, one line in the income statement. Well, in the income statement, we're simply seeing our share of its earnings So our share of its net income. Where does this go in the balance sheet? Well, in practice, there's not a huge amount of guidance in the accounting standards for where it should go. Having said that, in the CFA curriculum, in a later reading, we're asked to strip out the impact of equity accounted associates from the DuPont ratios. And you remember the DuPont ratios from your level 1 syllabus. Now, in order to do this, we need to know where the equity accounted investments income is in the income statement. And that reading treats it as being after the tax line. So just be a little bit aware. Sometimes in questions you might see the earnings, the equity accounted income from associates being above the tax line. Sometimes you might see it being below the tax line. But in that later reading, in order to adjust the DuPont, we're going to need to treat it as being after the tax line. Okay, fair enough. Let us move on then to look at evidence of significant influence. So these are really what we should be looking for to ascertain that there is an influence over another entity. In particular, a very classic one is simply we have representation on the board of directors. So we have a place on the board of directors. But there's participation in policy making, so we're affecting the operations of the company, the investing of the company, the financing, but remember we don't have ultimate control. This one's quite a nice one. Material transactions between the parties. Material being substantial transactions. It might be sales between the two companies. It might be sharing of technology. And you can see that's also that point there. Or interchange of key personnel. So in other words, the two companies are related and we have an influence. So we can influence financing, operating, investing, and the amount and timing of dividends. That's going to have an impact on our earnings quality, but we'll talk about that later. Okay, so let's get into how this actually works. So company P invests $1,000 in company S in return for a 30% stake. So it's an equity investment and we're obtaining 30% of company S. Earnings and dividends for the next 2 years are. So notice we're looking at our associate here. Company S is our associate. And we've been given its earnings and dividends in 20x6 and 20x7. Now remember what we're going to do is we're going to bring in our share of that. So when we look at its earnings, we're going to say, okay, hang on a second, we own 30% of the company. So we're going to multiply by 0.3, and that means we're going to be bringing in $120 of income, and that's going to go through our income statement. Again, multiply by 0.3, the dividends, and that means a dividend of $30. Now remember that dividend is going to affect the balance sheet investment, but it's very important that it doesn't go through the income statement. If we're bringing in our share of earnings, if we also included our share of any dividend that it paid in our income statement, we would be double counting. You can't include the dividend and your share of its net income, otherwise you double count. So we're going to bring in our share of its net income. We're not going to include our share of any dividend paid in our income statement. Same for X7, let's have a look at that. So 30% of this value gives us $180 and 30% of the dividend, $45. Okay, let's have a look then at how this actually works. So notice there is the opening balance, and that of course is the original purchase price. So remember, within that figure is our share of its fair market value net assets at the date of acquisition plus the goodwill figure. But then what we're going to do is bring in our share of its earnings. Okay, yeah, original investment. Our share of its earnings, 120 that we calculated on the previous slide, minus our share of its dividends. So remember, we're bringing in our share of its retained earnings, which is like our share of the change in its net assets. Okay, so therefore what we're doing is we're increasing or decreasing the investment each period for the change in the net assets of that associated entity. So in other words, our investment goes up by our share of its net income and down by our share of its dividend. So at year end it's sitting at 1,090. What's happening in our income statement? And remember, typically treat this as going through the income statement after tax in the CFA exam. Notice our share of its net income. Now this has led to a question that I've received a number of times over the years, and that is, hang on a second, look, the balance sheet investment is increasing by a net 90, but the income statement is showing 120 of earnings in it. So the income statement goes up by 120, then retained earnings goes up by 120. But balance sheet assets is only going up by 90. How does the balance sheet balance? Well, of course, it does still balance. The other impact is your cash will have gone up by 30 by the dividend received. So actually the original investment's gone up by, the investment's gone up by 90, cash has gone up by 30 because you received a dividend, 120. And then, of course, retained earnings goes up by 120 due to the earnings recognised in the income statement. So it does all still balance. So let's have a look at 20x7. So our starting point, of course, is the finishing point for x6, so the investment value at the x6 balance sheet. Then again, we're going to bring in our share of its net income, so 30% of 600, which is of course 180, minus our share of its dividend, 45, to give us a closing balance sheet investment of 1,225. And remember, we said these closing balance sheet amounts essentially are reflecting our share of the fair market value net assets at acquisition. I'm going to say NA for net assets at acquisition, plus our share of any change in net assets, plus goodwill, essentially. So that's what we're seeing in these year-end carrying values in our balance sheet. Okay, so let's talk about purchase price above the book value of net assets acquired. In particular, what we're now going to start to see is the goodwill and how we work out that goodwill element. So Red Company has purchased a 30% stake in Blue and they've paid $80,000 for it. At the acquisition, the following data applies. So we've got the associate's book value of its assets and liabilities, and we've also got the fair value of its assets and liabilities. Okay, so look, if we were to bring in our share of its book value net assets, let's just multiply that by 0.3. That would give us, what would that give us? 60,000, sorry. There we go, 60,000. Whereas if we bring in our share of the fair market value net assets, that would be 75,000. Okay, now notice, this is because the fair value of the assets and the book value of the assets subtly differs. And notice it's the PP&E, which is a very common one. Because remember, in particular under US GAAP, plant, property and equipment will be sitting there at historic cost, less accumulated depreciation, which of course could be very, very different from the current fair value of property. In this case, we can see actually the fair value of the PP&E is $50,000 greater than the book value of PP&E. Now, of course, if we take our share of this fair market value adjustment, that's going to give us 15,000. And of course, you can see that is actually the difference between the two amounts. So of course, just be a little bit aware that when we acquire an associate, what we're going to do is look at the fair market value of its net assets rather than the book value of its net assets. Okay, so we're told that Blue's equipment is depreciated over a 10-year period using the straight line method. Blue reported net income of 100,000 and paid dividends of 60,000 in the first year after the investment was made. And we've been asked to calculate three things here. The goodwill, remember, doesn't show up as a separate intangible asset. It's hidden away in that purchase price. The earnings attributable to the equity investment in the first year and the carrying value of the investment at the end of the first year in the balance sheet. Okay, let's first of all look at our goodwill calculation. Here, what we're doing is comparing the purchase price to our share of the fair market value of the net assets acquired. Now actually, remember of course, the fair market value of the net assets acquired, notice it is 75,000. We calculated that on the previous slide, 30% of the fair market value net assets of 250,000. But notice that's made up of our share of the book value of net assets plus our share of the fair market value adjustment. Remember, we've increased its PP&E by 50,000. Our share of that, 30% of 50,000, 15. Okay, so what we're doing really is comparing the purchase price to our share of the fair market value net assets at the date of acquisition. And that gives us our goodwill figure. It's actually, there are two forms of goodwill, as we're going to see later once we look at our subsidiaries, and this is known as partial goodwill. Okay, so we're calculating partial goodwill for equity accounted investments. Right, so we now know our goodwill figure is the difference between the purchase price and our share of fair market value net assets. Let's turn our attention to the income statement, essentially. Now, of course, first of all, we bring in our share of its net income. We were told that it generates net income of 100,000. So our share of 100,000, 100,000 times 30%, well, that gives us, of course, our 30,000 figure. But remember, we made a fair market value adjustment to the PP&E at the date of acquisition. We essentially increased our PP&E up by 50,000. Now that's going to mean there's more depreciation essentially going through the accounts. So notice our share of that PP&E adjustment, there was the fair market value adjustment, 50,000. Our share of that, 30%, gave us 15,000. And we're depreciating that according to its depreciation policy, straight line, 10-year period. So of course, 15,000 divided by 10 years is going to give us 1,500. So we're saying that as a result of our fair market value adjustment, there is an additional $1,500 of depreciation that is going to go through the accounts, essentially. And that's going to reduce the net income that we show. So notice, therefore, in our one-line consolidation in the income statement, we don't show 30,000, we show 30,000 less our share of the amortization of the fair market value adjustment. So we can actually show 28,500. Now that's going to impact the income statement, and of course it's also going to impact our balance sheet investment. So when we look at our balance sheet investment, there's the purchase price of 80,000, made up of our two components, of course, made up of the 75,000, which is our share of the fair market value net assets, plus the goodwill figure of 5,000. Okay, those are the two components hiding in there. We then bring in our equity income. Now remember, our equity income is made up of the 30,000, our share of its net income, minus our share of the amortization fair market value adjustment, the 1,500. Then deduct the dividends. It paid out a dividend of 60,000, so 30% of 60,000 gives us 18,000 and our year investment of 90,500. So key learning point here is fair market value adjustments that you make at the date of acquisition will impact on future income statements. They'll therefore affect your one-line consolidation in the income statement and your carrying value in the balance sheet.